What do you do when a good stock falls? Let's take Palo Alto Networks and let's go back in history so we know what the outcome was. And let's assume for the moment, because we can see it on the screen, it is indeed a good company on the basis it just keeps going up and up and up. Okay, so we'll make that little assumption. That's 455% return over the last 5 years, pretty much the period over which my friend Nikesh Arora has been chief executive. He's a smart cookie. Now, there have been periods when it's fallen off a cliff. It announced earnings around this period, dropped 31% in just a week, because whilst it had beaten many of the numbers that it was expected to deliver, there was some concern about whether or not it could continue the kind of growth it has seen previously. Now, guess what happened? Since that period, you would have been better off, obviously, buying that dip or just holding on. So you had three choices: buy, hold, or sell. The worst thing to do, it transpires in hindsight, was to sell. The best thing to do was to buy more or to continue holding. You want the kind of companies which, even if they drop significant amounts in a short period of time, you are better off those three decisions, where you want to either buy because you've got the capital, you're more risk loving, hold because you're risk neutral, rather than sell, which would suggest you're risk averse and suggest you're more like a trader and a gambler. If it forces you to sell, you're probably in the wrong company, have too much money in it, and have taken more risk than you're comfortable with. Now, could we have foreseen that price drop? Of course not. Wall Street didn't see it. Okay. Could we have seen the bounce back up? Well, that's a bit trickier. In hindsight, you might say, well, it's always moved in this kind of a channel, and as long as it doesn't break below the channel, you're fine. And if it hits the bottom of the channel, definitely buy back in. And if you look at it, this company has a habit of making those kinds of big falls. It's clearly the kind of company which, if it ever does drop 20%, indeed even 30% from its high, instead of having a trailing stop, you should have a trailing buy. Now, you've never heard of trailing buys. I've just invented the term. Trailing buys are in the kind of companies which, time and again, just deliver good returns when they fall. What's the trailing buy on this one? Should it be 36%? Well, that happens to infrequently. Should it be 30%? Again, a bit infrequent, 29 to 30%. Should it be after 20% drops? Probably after a 20% drop. Classic example of a trailing buy. So, lessons learned. If we were to summarize: one, you want the kind of quality companies based on value, growth, income, cash flow, where you either want to buy more or at least continue holding. And in terms of buying more, you have that concept of a trailing buy. If you have to have the concept of a trailing stop, you're probably either seeking a lot of control. The risk of that is you exit prematurely, but you wanted the control and there's a price to pay for control. Or because of the trailing stop, you're trading, in which case you're gambling on timing and so on, and that's very difficult to call right, and it's usually better to sit back. Anyway, hopefully you found that helpful. I've got a lot more information on alpeshpatel.com/links. If you want a free educational call about pensions, it's also on the same URL. Thank you.